In this video, I want to talk about asset allocation strategies. Now, asset allocation deals with how an investor divides up their assets among the different asset classes: stocks, bonds, cash, real estate, etc. Now, studies have shown that 90% of your return can be attributed to asset allocation. It's not about picking winning stocks, it's about how you divide up your assets. Now, aside from deciding what allocation you want, do I want 70% stock and 30% bonds, or 50% stock and 50% bonds, there are different strategies you can use to adjust your portfolio. And we're going to take a look at three of these here. There's the buy and hold strategy, there's the constant mix strategy, and there's a constant proportion strategy. Now, the buy and hold strategy is the case where you simply buy the stock and hold on to it, okay? Or you buy the mutual fund and you hold on to it. You don't change your allocation in your portfolio. You buy stuff, you just hang on to it. Doesn't matter what happens. And if the stock prices go up, you'll have a higher percentage in stock. So you might have started with 50% stock and 50% bonds, but stocks went up relative to bonds. Now you have 60% stock and 40% bonds. Maybe the market continues to go up, and now you have 70% stock and 30% bonds. On the other side, if the stock prices fall, you'll have a lower percentage in stock. So instead of being 50-50, you might have 40% stocks and 60% bonds, etc. Now, let's look at something referred to as a constant mix strategy. And after I discuss this one, we'll go back and we'll compare the buy and hold with the constant mix strategy. This is common. You hear this a lot from financial planners. Choose an allocation, for example, 60% stock and 40% bonds, and maintain that allocation. Okay, some advisors will tell you 60-40, some will tell you 70-30. There are different rules of thumb people have where they'll say take 100 and subtract your age, and that's the proportion of stock you should hold. So if you're 20 years old, you should have 80% in the stock market. If you're 70 years old, you should have 30% in the stock market. I mean, these are general rules of thumb. They don't work for everybody. It depends on your wealth. It depends on your income. It depends on a lot of things. But people will use these guidelines sometimes. In this case, what you're going to do is you're going to rebalance your portfolio to maintain these proportions. So if the stock market rises, as we mentioned with the buy and hold, you'll have a higher percentage of stocks and a lower percentage of bonds. So what are you going to do? You're going to sell stocks and buy bonds to bring your proportions back to 60-40. If the market falls, you're going to have a higher percentage in bonds than you want and a lower percentage in stocks, so you'll sell bonds and buy stocks to get back to those proportions, that 60-40 or 70-30, whatever you decided on. Now, you have to keep in mind that adjusting your portfolio is costly. So you don't want to change this every single day. You don't want to say, well, the market went up today, so let me sell some of my stocks and buy some of my bonds, buy more bonds. Or the market went down today, so let me sell some bonds and buy some stock. So you want to do this, and it's not only costly in terms of transactions costs, it's costly in terms of time. If you have to make this adjustment every single day, you've got to watch the portfolio day in and day out. In fact, theoretically, you could do it every hour or every minute, but it gets very expensive. So most advisors recommend that you, for example, when you get your quarterly statement from your mutual fund or from your brokerage account, to adjust then, or perhaps semi-annually, or even annually. Other choices might be to adjust when the proportions change by enough. So instead of saying I want 60-40 in stocks, maybe 60% in stocks and 40% in bonds, maybe I'll say I want 60 to 65% in stocks and 35 to 40% in bonds. And when it changes by outside of those ranges, I'll adjust. Or if it changes by more than 5%. So if I go from 60% to 55% in bonds, in stocks, I'm going to jump in and buy more stocks to bring the proportions back up. On the other hand, if I get over 65% in stocks, I'll sell some of those and buy bonds. Okay, I could also use changes in a market index as a guideline. You can set the rules yourself. Now, which one works better? Well, which strategy performs better depends on how the market's behaving. If the market tends to rise with few downward corrections, buy and hold is best, because the constant mix strategy is going to have the investor selling stocks into a rising market. You don't want to maintain 60-40. You want to have 70, 80, 90%. If the stocks are continuing to go up, you want to own as much stock as possible. And by a rising market, we mean something like this. Okay? It's not going straight up. There are some blips down, up and down, but for the most part, the trend is upward. So you can see when it goes up, you're going to have more than 60% in stocks, so you'd be selling some of those. And then it's still going up, so you'll have more than 60%, so you'll be selling some of your stocks. And perhaps that's not the right strategy. Okay? On the other hand, if the market tends to remain flat but oscillates, that is, it goes up and down, but it doesn't trend upward, or the trend is flat, then the constant mix strategy works well, because you'll buy stocks when the market falls, you'll sell stocks when the market rises. This is what we mean by a flat and oscillating market. See, the trend is flat, but it's going up, and then it's going down, and it's going up and down and up and down. And the constant constant mix strategy is going to tell you, hey, you're up here, you've got too much in stocks, so sell some of your stocks, and then when the market falls, you'll have too little in stocks, so sell some of your bonds, buy more stocks. So you're going to be buying when the price is low and selling when it's high and buying when it's low, and this can be a very good strategy if the market is going up and down. In fact, a lot of financial planners recommend that investors purchase balanced mutual funds. These are funds that invest in both stocks and bonds, might maintain a proportion of, let's say, 60% stocks and 40% bonds, and the portfolio manager is going to be forced to sell when stocks are high in price and buy when stocks are low in price. And it's a forced discipline, which is good. The third strategy we want to talk about here is something referred to as constant proportion strategies. Here what we're going to do is maintain a fixed proportion of assets in stocks based on the difference between the value of assets and some predetermined floor for the portfolio. What do I mean by a floor? Well, you set some minimum level below which you don't want to fall. And we get this equation here. The dollars invested in stocks are going to be equal to M, which is just a multiplier, and I'll talk about that in a second, times the difference between the assets and the floor. And the idea here is basically that when you're far away from the floor, you're going to put more money into stocks. And when you get close to the floor, when you get close to that minimum amount below which you don't want your portfolio to fall, you'll hold less in stocks so that you'll be safer. Okay? This M is a fixed multiplier, and there's a strategy referred to as constant proportion portfolio insurance. Portfolio insurance was a strategy that a couple of University of California professors, Mark Rubenstein and Hayne Leland, came up with back in the 80s, that basically was an idea to create a call option payoff strategy, one that gave you upside but limited your downside risk. A call option has a payoff where you have very limited downside. If the market goes down, you can only lose the premium. If the market goes up, you can make a lot of money. So they came up with the strategy of adjusting the portfolio. Now, there's some similarities of constant proportion strategies to constant mix strategies. It turns out that a constant mix strategy is a constant proportion strategy with m equal to 1. All right, let's consider an example. Suppose you have a multiplier of 2. That makes it constant proportion portfolio insurance. Any multiplier greater than 1 makes it this portfolio insurance, or CPPI. Let's say we have a floor of $75 and we have total assets of $100. So we really don't want to fall below $75 in our portfolio. If the total value of our assets is 100, then we take 100 minus the floor of 75 times 2. So we want to hold $50 in stocks. Now suppose that the stock market falls from 100 to 90. The investor's stock will fall 10% from 50 to 45. Remember, you had $50 here. Okay, this is a 10% drop. So now you have $45 in stock. Remember, you don't have all 100 in stocks. You only had 50 in stocks. So it falls from 50 to 45. But according to this CPPI, the stock position should be 40. How does that work out? Your assets are 95. Remember, you have 45 in stock now. Remember, you put 50 in bonds. So you have 95 minus 75 times 2. So you really should have 40 in stocks. So this strategy, the CPPI, tells us to sell stocks as they fall and buy stocks as they rise. Now that seems kind of counterintuitive. You're always taught to buy low and sell high, but this strategy is the idea of protecting yourself. As the market is falling, you get out of the market a little bit at a time. But when the market's rising, you become more aggressive. Okay, this strategy works well when the stock prices tend to move upward because you keep increasing your stock holding as stock prices rise, but it doesn't work so well in a flat and oscillating market. So again, I've recreated these two diagrams. When the market's going up, CPPI keeps telling you, hey, you're getting away from your floor. The total value of your assets is further away from the floor. Increase your stock holdings. And that's a good thing, because the more stock you have, if the stock market is rising, the better off you'll be. However, if you have this flat and oscillating market, it goes up, it goes down, it goes up, it goes down, it's going to tell you to buy here and sell here. So you're going to be going up and down, and that's going to be not a very good strategy.